All right, today we're going to put one of the world's most legendary companies on the examination table, Berkshire Hathaway. We're going to look right past all the headlines and use a really disciplined, a Buffett-style approach to see what story the numbers really tell about its financial health.
So first, let's just pause and look at this number, $1.014 trillion. That right there is the market cap of Berkshire Hathaway. It's a number so huge, it's almost hard to wrap your head around. See, analyzing a company this size isn't about just one number. It's about trying to understand this vast, complex financial world. When you're faced with a wall of data for a trillion-dollar company, it can feel pretty overwhelming, right? So how do you cut through all that noise? Well, we're going to tackle it systematically. We're not looking for a simple yes or no here, but for a much deeper understanding of its actual health and performance. And to do that, we're going to use a simple 4-part checklist, a kind of disciplined approach that, honestly, Warren Buffett himself would probably appreciate. We'll kick things off with its valuation, then we'll jump into profitability, check on its growth, and finally, we'll look at the really important one, the long-term picture. First up, the valuation check. This is the classic investor question, right? We're not just asking what's the price, but is that price actually a good value? Is Berkshire Hathaway, on sale? So a great tool for this is the price-to-book ratio. Think of it this way. If a company sold off everything it owns, all its assets, and then paid off all its debts, whatever's left over is the book value. This ratio just compares the stock price to that underlying value. A lower number could suggest you're paying less for more stuff. Okay, so Berkshire's current price-to-book ratio is 1.42. Now, what's really interesting here is that this is actually a little bit below its 3-year average of 1.52. That might suggest that, relative to its own recent history, the stock isn't trading at a premium right now. But as we're about to see, that's just one little piece of a much, much bigger puzzle.
Yeah, because valuation is never that simple. Asking for the one real price is kind of a trick question, because different completely valid methods can give you wildly different answers.
In this slide, wow, it perfectly captures that problem. Let's slow down here, because this is so important. If we value Berkshire based on its free cash flow, that's the actual cash its businesses are generating, we get a fair value of around $221. But if we use its official reported earnings, the model spits out a value of almost $900. Now with the stock currently trading around $470, one method says it's way overvalued and the other says it's an incredible bargain. The key takeaway here is that for Berkshire, reported earnings can jump all over the place because of accounting rules on its huge stock portfolio. Its cash flow, on the other hand, is a lot more stable. Valuation isn't science, it's all about perspective. All right, let's move to item number 2 on our checklist and see how this all connects, the profitability check. So here we're asking, once Berkshire has all this money, how good is it at actually turning it into profit? How efficient is this massive machine? A classic metric to look at here is return on equity, or ROE. Honestly, you can just think of this as a report card for a company's management. It basically tells you, for every single dollar shareholders have put in, how many cents of profit was the management team able to squeeze out. Berkshire's current return on equity is 9.33%. And what's great is that that's remarkably consistent with its 3-year average of 10.77%. This tells us that management is consistently and pretty effectively using shareholder money to generate profits. It's a really good sign of a steady, well-run ship. And check this out. Here's another angle on its efficiency that is just, well, it's pretty remarkable. A net profit margin of almost 20%. I mean, that is incredibly strong. It means for every $100 that comes in the door, after you pay for everything, the railroad, the insurance companies, you name it, almost $20 is left over as pure profit. That is a truly impressive number. Okay, on to our third stop, the growth story. This is a huge question for a company this big. I mean, can a trillion-dollar behemoth still find ways to grow in a meaningful way? This chart of the 3-year average growth rates tells a fascinating story. You see some nice, solid growth in revenue and cash flow on either side. But look at that enormous bar in the middle, net income, a staggering 70% average annual growth. That just points to a period of explosive profit expansion. But, and this is a big but that connects right back to our valuation puzzle, we have to add some context. While that 3-year average is incredible, the most recent 12 months actually saw net income go down by about 25%. Now that doesn't cancel out the past success, but it shows that growth, especially profit growth, can be really volatile. and it highlights why looking at different timeframes is just so critical. And that brings us to our final and maybe the most important check of them all, the long-term picture. This right here is the bedrock of the entire Berkshire Hathaway story. In a world that is obsessed with the short term, does patience really pay off? This table tells the whole story. Yes, if you only look at the past year, you see a negative return. But watch what happens as we zoom out. Over 3 years, you're up nearly 44%. Let's keep going. Over 5 years, 73%. Now look, over 10 years, your investment has more than tripled. And over full 20 years, a staggering 714% return. That is the power of compounding in action. That is the Berkshire way. So, what did we learn from our little checkup? Well, we see a company that is highly profitable and has delivered absolutely incredible long-term returns. We've also seen that trying to put a single fair value on it is really complex, and it completely depends on which numbers you focus on. And finally, we've seen that its recent growth has been powerful. But yeah, it's also been pretty choppy. The goal of all this wasn't to tell you what to think about Berkshire Hathaway. The real goal was to give you a framework, a method you can use to look at any company, ask smarter questions, and build a more complete picture for yourself. So that leaves me with one final question for you. Now that you've seen how all these different metrics can tell a story, if you were building your own checklist to understand a company's health, where would you start? Which metric matters most to you? Thanks for joining me on this financial checkup.